Hi, this is Professor Cataldo, and I'm going to go through some basic U.S. GAAP, generally accepted accounting principles, typically introduced in an introductory financial accounting course. Now, generally accepted accounting principles, what are they? Those are practices in accounting governed by concepts and rules, and these are the three you want to focus on. I want to provide users of financial statements, financial information, with information that is relevant, reliable, and comparable. Relevant. It has to be relevant, or it won't assist a user of the financials in their decision-making process. It has to be reliable. I have to be trustworthy and trusted. And it has to be comparable. If I use one method of accounting last year, I need to use a comparable or the same method this year. And as your introductory course progresses, you'll find out there are alternative methods that are generally accepted. These are the principles and assumptions of accounting. Far left-hand side first. The measurement principle, also called the cost principle, it's also called the historical cost principle. And all that says is that we want to record transactions at their historical cost. If I pay $100,000 for a building, I want to record it as an asset at a cost, historical cost of $100,000. The revenue recognition principle. That provides guidance on when you must recognize a revenue. When is the earnings process complete? The matching principle, also known as the expense recognition principle. In broad general terms, I want to match the expense to the revenue. So if I own a retail store and I'm selling something for $5 a unit and it costs $2 a unit, my profit's $3 a unit, I want to match the two. I don't want to record the $5 revenue in one period and the $2 expense in a different period. That would not match. It would not provide users with useful information that is relevant to their decision making. The full disclosure principle. I'm going to provide basic financial statements, but some of them require elaboration or additional disclosure. That's usually in the footnotes to the financial statements. Going concern assumption on the right-hand side. These are my assumptions. First, I'm going to assume that the firm will continue to operate and function as a going concern. If I did not do that, and I was using, for example, the historical cost principle, let's say I was entering bankruptcy, that $100,000 historical cost piece of land I purchased in bankruptcy proceedings might fetch less than $100,000 if I had to sell it quickly. Real estate's not a very liquid asset. So the going concern assumption, in the absence of evidence to the contrary, and that's a more advanced topic, I am going to assume that the firm is not going to go bankrupt. It's going to continue as a going concern. The monetary unit assumption. Right now, in November 2018, inflation in the US is running about 2%. That's very tolerable. And we're going to assume that the US dollar is not going to collapse. The currency is not going to collapse. So we're going to record all transactions in terms of US dollars. The time period assumption, also known as the periodicity assumption. I'm going to prepare financial statements at and for particular time periods. People want to know probably how I did over the month or the quarter or the semi-annual period or annually. Certainly, I have to prepare financials annually to produce and prepare my tax return. And the business entity assumption. If I have a corporation, I do not want to commingle personal assets with corporate assets. I want all of the transactions that I'm presenting in my financial statements to have to do with and deal only with that particular business entity. It could be a sole proprietorship, a partnership, a corporation. For the purpose of most introductory financial accounting courses, we assume the corporate form of business entity. Thank you.